You can solder the perfect circuit, write flawless code, and build a machine that works magic on a workbench. But if you don't understand the forces dictating how it gets into a customer's hands, that prototype stays exactly where it is. It gathers dust. Engineering solves the technical problem, but economics determines if that solution ever leaves the room. The course Industrial Economics and Foreign Trade provides the analytical framework for that transition. It moves beyond the mechanics of the machine to the mechanics of the market. We are going to map out the economic life cycle of a tech startup in 5 sequential phases: proving market demand, optimizing physical production, navigating competitive structures, managing macroeconomic risks, and finally, executing a global expansion. These 5 modules track the specific hurdles a technical project must clear to transform from a lab experiment into a commercially viable enterprise. The production possibility curve visualizes a startup's foundational problem, scarcity. With limited resources, businesses must choose what to produce. Growth occurs when a firm stretches these limits, pushing the curve outward to show expanding potential. But producing a good means nothing if people don't value it. Consumer demand is driven by utility, the satisfaction a user gets from the product. The catch is the law of diminishing marginal utility. The first unit sold provides the highest satisfaction. Every subsequent unit generally provides less and less value to that same user. Finding the exact price point where the product supplied matches consumer demand is market equilibrium. Our ability to set that price depends on elasticity, measuring how customer behavior changes when the price moves. On a supply and demand graph, inserting a government tax creates friction. This tax wedge separates what consumers pay from what producers keep. The resulting red triangle represents deadweight loss, economic value permanently lost to both parties. Proving market demand and finding equilibrium is the first step. But even with a validated market, the product must still be manufactured within the physical constraints of an industrial facility. Now we move from demand to physical reality. We use a production function, like the Cobb-Douglas model, to calculate how inputs like labor and capital yield our final product. As we add staff to the assembly line, we navigate the law of variable proportions, tracking the diminishing returns of each new hire on our total output. The financial objective is to scale efficiently. By charting an expansion path, we aim to achieve economies of scale. This is where per-unit costs drop as the operation grows, driven by internal efficiencies or external benefits like improved local infrastructure. Operating a factory involves complex expenses. We have explicit costs like wages and rent, but also implicit costs, the value of resources the owner provides that could have earned money elsewhere. And we must account for sunk costs, capital already spent that cannot be recovered. This chart plots factory cost curves. Where price meets average total cost, we hit the break-even point. If price drops to average variable cost, this red mark, we hit the shutdown point, unable to cover basic operational costs. Efficiency is the primary metric for survival at this stage. Regardless of market demand, a factory will fail if its internal costs are not managed against these curves. If the factory is stable, we then face the market structure.
This ranges from perfect competition, where many small firms sell identical goods, to a pure monopoly, where one seller controls the entire supply, a situation that often triggers government regulation. This table compares demand curve shapes. Many firms operate in oligopolies, defined by the discontinuous slope of the kinked demand curve. Raising prices loses market share, while lowering prices causes immediate matching. This rigidity often drives firms toward collusive behavior. To gain an advantage, we deploy specific pricing strategies. We might use penetration pricing to capture a new market, predatory pricing to weaken rivals, or price skimming for early adopters, before lowering it for the public. Success in a competitive market requires aligning these pricing tactics with the specific structure of the industry. Our business is also a component of the national economy. Every wage we pay and unit we sell contributes to national income and the gross domestic product. This exposes the firm to macroeconomic risks like inflation. When the general price level rises, it erodes purchasing power and increases input costs. To manage this, the government uses monetary policy to adjust interest rates and fiscal policy to change taxing and spending levels. To weather these fluctuations and fund growth, firms raise capital. They may issue bonds in the money market to take on debt, or sell shares in the capital market to trade ownership for cash. The Bombay Stock Exchange is the center of these capital markets. Once shares are issued, they are stored in demat accounts and traded publicly, with the firm's performance contributing to major indices like the Sensex. At this scale, the internal health of the company becomes inseparable from the stability and capital flows of the national economy. The final stage of expansion is international trade. This offers access to new markets and foreign capital, but it also introduces risks related to political dependence and the depletion of a nation's natural resources. Nations trade based on the theories of absolute and comparative advantage. Even if one country is better at producing everything, both nations can still profit by specializing in what they produce with the lowest opportunity cost and then trading for the rest. This global exchange is recorded in the balance of payments. If a country imports significantly more than it exports, it creates a deficit. To correct this, a government may choose to devalue its currency, making its exports cheaper for the rest of the world. Entering these markets requires navigating trade policies. Firms must deal with protectionist measures like tariffs, direct taxes on imports, and non-tariff barriers such as specific health, safety, and packaging regulations. Global expansion requires a firm to leverage comparative advantages while successfully managing these international protective barriers. We have traced the path from a prototype, limited by scarcity, to a global enterprise navigating international trade policy. Each module is interconnected. Consumer elasticity dictates the revenue available to cover factory costs. Those costs determine the pricing strategy used against rivals, and the success of that strategy determines the firm's ability to raise capital and eventually export goods. The formulas and graphs of industrial economics provide a cohesive map for industrial growth. They offer the tools necessary to evaluate, protect, and scale an enterprise in a global market.